So depending on how competitive you want your offer to be, you could be paying your own closing cost to make that one thing that the other side isn't contributing to, and to put you at the top of the line against other offers. In an event where you found a property that's been on market for several weeks, it's got less interest, less activity, you could ask the seller to pay those closing costs using a seller concession. So that credit would go towards the amount of closing costs. For an FHA loan, that could be up to 6% you could ask for. A VA loan, it says 4, but really that number is almost, I don't want to say unlimited, but it's much greater than 4%. And a conventional loan with a minimum amount down is 3%. As you get into 10 and 20% down, you could ask for more, but not typical in those situations. Costs to close the transaction that are unassociated to the actual property, meaning these things don't, while they have a cost and value, they don't have a value that's associated with the property itself. It's why they can't be included. So taxes, transfer taxes, title fees, costs from the lender, any discount points associated with the loan, the appraisal. These are all items that are bundled up, amount to typically, we like to say, around 3%, in some cases 3 to 4%, depending on the value of the property. So the lower the value of the property, so you're, say, less than $300,000, that number might be closer to 4% than 3. And then as you get to 400,000, you kind of average out around 3. And then when you get to 500,000 plus, you're probably looking closer to 2.5% as far as what you're looking at a number overall. You'll also find that 3%, just as a mental rule, gives you a good idea of what you're going to need to bring. So when we get into the term waived appraisal, it can actually mean a couple things these days. You may be waiving the appraisal for the concern of the seller, but you could still be responsible for having one as per the lender. Meaning there's so many things that go into generating an appraisal waiver. USPS address must be identical with how the last recorded value existed to how the property is being marketed now. Recently ran one where a county here in Virginia had changed the 911 address because they had added a fourth home to the road, which triggered the private road changing to a public road and additional name change. So then, even though the borrower was putting 40% down, we weren't getting findings that we kind of expected. But then later found out the reason, most likely why, was the USPS did not match that address. Now, when I say this can vary, that your lender may require it, but the other side, you've given a commitment that you've waived it. So let's say that the property you're buying is $400,000, what it lists for, and you end up paying $470,000. And there's concern by the agents that this property is not going to appraise for $470,000, but you've said that we're going to pay you that much money no matter what. So if the property appraises at 425, you're going to be responsible for that delta in between. So you've waived the appraisal, but your lender is still requiring one. The buyer is always responsible for the gap if they agreed to pay the gap. If the gap was not agreed to in the contract, and let's say they said, we are willing to pay $5,000 over the appraised value, and the other side agrees to that. So in this scenario, you're buying a house that is listed for $400,000. You've agreed to pay $5,000 over the appraised value, and the contract price is for $430,000. So if the appraisal comes in at $410,000, the new contract price would be $415,000 because you've agreed in the beginning that you're willing to pay $5,000 over the appraised value. The sellers agreed to that as well, so end up paying $415,000. We were underbuilt for over a decade, not nationally, but locally as well. So the only projects that have been turned back on were projects that were already previously approved. We've got local municipalities who have not leaned into greater development, and there's some good reason for that. The cost per burden for the municipality is roughly $1.15 for every dollar collected in taxes for each new house that is established. So that's a strain on our local resources as far as social services and that type of thing. And then there's also just the trades themselves that we run a shortfall of, or have for the last 15 to 20 years. Now that we want to turn everything back on, trying to actually get the projects approved and the humans who can go do that work has been a challenge. So it's not just the land prices, it's also the availability of the land. It's not like there's a ton of 3 to 5 acre lots that are just available all over the place. And then to take a large parcel, get it approved, we've just established that these municipalities aren't allowing that. So it really is going to take finding small parcels of land for mid-sized developers who can go and build a affordable home, something that they could bring to market at less than $400,000 to be able to get people in these homes. Because it's, to go put $1 million homes on 10-acre parcels is not going to satisfy the housing need that we're currently in. When you talk to anybody on the phone, they go, I don't want a lot. I just want something, 3 bedrooms, 2 baths on 3 acres. And it's like, where do you want it though? Because that property, if you're within, say, 30 minutes of Charlottesville, that's probably going to run you, on average, you're finding there's some stuff that's coming on at Lake Monticello and some other areas that are less than $400,000, but that's typically going to be, $500,000 or greater in a lot of areas, which makes it's challenging. Now your super high end stuff, you're seeing that still like really, selling pretty well, as long as you're within a small drive of nice things like grocery stores and activities and things to do. When you get into more rural areas, there's some properties in green that plus $700,000 mark that are starting to sit a little bit, but I think that is also rate driven. I think if we get into an environment where we can get sub 6.5, sub 6%, we put something in the 5s, then you see a lot more activity in those numbers in those areas. The first thing I would look at is renting that property that you currently hold, and even with a minimal down payment, getting into the next property. With the idea that if you can afford it now, you'll definitely be able to afford it if rates fall and you can refinance. So you've got a property that you own that you can rent for greater than the mortgage amount, so you have an income producing property, and then you have the ability to get into your next property. Now, let's say that you don't have a down payment, or you're focused on putting 20% or more down. Then that's something that you may want to look at, taking a home equity line of credit out on the existing property that you're going to rent. Make sure that the rent covers whatever that HELOC amount plus the existing mortgage would be. Use that money for the down payment and closing costs, whether it be 5% or 20% and closing costs that you're trying to make, to get you wherever you need to be. So you've got rent that covers your existing cost, and then you've got a down payment that's going to get you into the next property and make you more competitive. It depends on what your timeline looks like and what your life scenario looks like. Like, are you a single dude who is, comfortable living with a couple cardboard boxes and some, a pizza, television, and that's your life? I mean, then maybe you're not settled enough. Are you a family that needs to take the first step? Well, I can tell you right now that getting in and building some equity now is going to be better for you down the road than waiting And then assuming rates do begin to fall, we're not unlocking all this inventory at one time. We're not gonna see some great decrease in value, especially in this area, given the amount of jobs and humans that the University of Virginia is putting in, NJIC is allowing, Amazon is coming to parts of Northern Virginia, and all that's starting to filter down and push jobs further and further this way. If you can, you should, because the longer you wait, the more expensive it's going to be. So in this scenario, let's say that you have a $400,000 purchase, FHA with 3.5% down. You've got annual taxes of $4,000. You've got annual homeowners insurance of $1,200, which gives you a total at 7%, gives you a total monthly payment of $32.25. Well, assuming that, let's say the rate at 7%, we could then refinance you at 6%. You would save probably $350 a month with those same numbers in that same scenario. Yeah, that is what a refinance would look like. So while you may face some increases with your homeowner's insurance and your property taxes, depending on if you have claims or if the county decides that they're not taking enough of your money, and when mortgage rates fall, which they're going to in some capacity, I can't tell you when or how, but it's going to happen, then you'll be able to refinance into a lower rate and lower that total monthly obligation.